If you're a regular listener of the PPW podcast, you're probably sick of this experience of listening to me talk about our sponsored PropTechs. But you know who won't be sick of their experience is your users if you start using PropTechs. Why? Because PropTechs makes those listings pages that have probably been the same for 10 years. They make them really engaging. Things like AI-driven shopping experience on the listings, AI-driven neighborhood details, AI-driven, you name it. PropTechs are experts. If that sounds good, head to proptechs with 2x's.com or hit the guys up on LinkedIn and say that we sent you. Hello and welcome to the PPW Pod, bringing you news, views, and interviews from the world of real estate marketplaces and PropTech. I'm joined for today's News Roundup episode by Simon Beike in Miami. How are you, Simon?
I'm doing very well, bright and early here. But who's going to argue when it's another beauty 30-plus degree day?
And Harvey Hancock from also sunny, probably a bit too sunny Madrid. How are you?
Yeah, very good, Ed. The aircon's been on for 5 days in a row now, non-stop, and you try and stay inside until the sun goes down. It's been pretty nasty, but in the best way possible.
Okay. As I said, this is a news roundup. We haven't done one of these for a couple of weeks, and we've just had this morning probably the biggest piece of news that we've had for the last 10 days or so. Harvey, why don't you fill us in?
Yeah, sure. REA Group has a new CEO, ladies and gentlemen. Those who know don't speak, and those who speak don't know. We had a short list of 3 names. Of course, the actual appointee didn't appear on that short list. We have a new CEO. His name is Cameron McIntyre. He's just left his role as CEO of Car Group, which is automotive's marketplace business across multiple continents. He's been appointed CEO of REA, and he will join at the start of November. Owen Wilson will leave at the end of October, and it's going to be a good old battle for him because there's a lot going on with REA Group at the moment. We've got the ACCC investigating them. We've got CoStar coming in the form of Domain, but he's got plenty of experience. He's overseen an IPO at Car Group. He's overseen cross-continental businesses who will have plenty of experience with the likes of REA India. Looks like a good appointment, Ed.
Thank you. Simon, could you give us a bit of context here? I have absolutely no idea about Car Group. Are we talking about a market leader here? Are we talking about a company that's come from nothing to build up a big business? Like, what's the story behind Car Group?
Well, I'm not really. I'm a real estate guy.
Just assume that as an Australian, you'd know. No, okay,
Nope.
fair.
No. I can honestly say I don't know. But what I can say is, and it's probably more about what the challenge is moving into the REA organization is if you think about this logically, you've got an organization that's been market leader for 25 years, 22 to 25 years in that range. Dominant player, capturing a large percentage already of the advertising spend in the market. They've got numerous challenges in an investment in the United States that's under serious challenge from both Homes.com and Zillow. You've got an investment in Australia, which has now got CoStar attacking it. Well, will be shortly anyway, I think, given that the Domain deal has finalized. And now you've got challenges in clearly the Indian market that's forever a challenging market to be in. So all of them mean that you are going to be faced with how do you run both a market leader and a challenger brand in various markets, which you've got almost like 2 different ways to think about a business. And how do you, as you become more and more under challenge in your core market from CoStar, how do you innovate? And then on top of that, and we mentioned this last week or the week before, is you also have the changing world driven by AI, artificial intelligence, that has the potential to fundamentally change how people search anyway. And if you're not careful, could make a business model that you've spent years building look more like the newspapers today than like the current business that you've got. So I think add all those together and you've got a lot on your plate. Plus you've got to deal with ACCC inquiries about anti-competitive potential behavior. So I think all of those will make it a very challenging welcome on the 1st of November for Cameron McIntyre.
Okay, why would REA Group have opted for somebody outside of, well, not only outside of the business, but outside of real estate? What kind of benefits are there to somebody who doesn't necessarily know about real estate?
Yeah, so the first clear benefit is the automotive industry is far more competitive, far more innovative, and operates on far smaller margins than the real estate industry. Cars are transferred far, if you think at the dealer level, let's go back at real basics, the advertiser level. I mean, they are buying and selling cars and making hundreds of dollars on each transaction, not thousands of dollars on each transaction. There are more transactions in 1 week in automotive than there will be in many months of real estate for a dealer. And when you add all this together, your customer base, wants that innovation, wants to understand how to use technology to just capture more and more of that margin. And then you look at the portals in the car space around the world, they've had to innovate their models. They're far more into the transaction space. You've got things like Carvana and things, those sort of businesses that have totally innovated how cars are bought and sold in a market. So you add all of this together, and you really do have, if you want to go somewhere to find a type of character, a person who has characteristics around innovation, then really you'd look at automotive or you'd look at jobs, probably before you would look at other real estate players around the world.
Okay. Harvey, when was it that Owen Wilson, the current departing CEO of REA Group, announced that he was stepping down? It was quite a while ago, wasn't it?
Yeah, it was at the start of the year. I'm going to put my neck on the line and say it was February this year. So it's been about a 6-month search.
Right. So I'm asking from a place of complete ignorance rather than trying to dig up any dirt here. Does it normally take this long to find a replacement for a CEO? It seems like quite a long search to me, especially given that they've gone for somebody who, I don't know, probably is, they would have known from the start, right?
Well, the question is, how long before the announcement of Owen's departure did the board know that he was departing, and did they start a search earlier than that? Normally, once you say, look, I'm thinking about leaving, maybe we should put some feelers out there. Let's see what's on the, is there anyone internally, and so on, right? And clearly, maybe what's happened here. I mean, I think we talked before about a potential split between News as a shareholder wanting one candidate and the rest of the board wanting another candidate. Maybe this is a compromise in that process as well. I don't know. Speculation. Okay. I mean, clearly, Cameron's been running Cars Group, or formerly Car Sales. Many people out there would know it as Car Sales, for what I think is, I was just doing a quick check then, since 2017. So it's got a long history in that process, and running a listed company, one that has clearly done well over that time. So I think probably what's happened is they've looked internally. They had a short list. They probably couldn't come to an agreement at a board. They've using an external recruiter for whatever reason. They've approached Cameron McIntyre and said, "Hey, why don't you jump from cars to houses? I mean, you're already based in Melbourne. It's easy. Okay. You've got multi-country experience with the car sales business, with Trader and Encar in South Korea and Chile Autos in Chile, of course. So you've got good experience, and you tick a lot of the boxes. Your understanding of how listed markets work. You have a brand with the investor community, which is always very important. So the investors feel comfortable that it's going to a safe set of hands. Although I don't think that really matters with REA, because they're looking more at the fundamentals, and they know that, and to get it wrong, you've got to try really hard, is the way to think about it. Okay. The question is, there's a band of growth that you're going to achieve. And then the question is, can you break out of that perceived band and go to a higher level. That's sort of where they've got to focus. So yeah, I can see why they've probably gone for a different candidate who ticks a lot of the boxes needed.
Could I jump in with one quick question before we move on, which is, so let's say, for example, Simon, you're hiring at a company that you own, and it's come down to me or Ed as the final two candidates to be CEO, and you've decided in your better judgment, it's definitely Ed. So you've decided it's definitely going to be Ed who's going to be CEO. How long does it take you to then negotiate those dealings to bring in a CEO? You obviously got salary, you've got maybe stock options, example. Is it going to be a 3-month process to actually sign the dotted line, or is it going to be a 2 weeks of heavy negotiations? I'm just trying to work out what that looks like internally.
Well, there's things. A is, does Ed want to leave his current job? Is the first thing, right? Or is he super happy? Has he got a lot of options, got a lot of value sitting on the table? B, what's his notice period in his current job? Okay. And you know, what do I need in terms of timing? And so you've got to take all those into account. Now let's assume that he's got a nice package and that he's got some options that will vest, or he will lose the options. So I've got to sort of give him probably a sign-on bonus equal to the value of the lost options is often what will occur. And then, you know, he's got to give notice. He's going to do it in a nice, friendly way because he wants to make sure he looks after his old board. Well, so that's why it takes quite a while. And given he's studying in November, and I would have thought there would be a 6-month notice period. So either he's negotiated it. I mean, I don't know these contracts, and we could probably go look at the Cars Group website and see it because it's always there in black and white. But usually it's like a 6-month notice period. So my guess is either, you know, this has been going for a while, we've just no one's heard of it, or B, he's negotiated his way out of whatever agreement he had, which is often the board can say, yes, we'll go your last 3 months of notice and good luck.
Yeah, so I think
it saves them money as well.
I think he announced he was leaving Car Group mid-July, and then a month later he's announced as CEO of REA. So clearly there were things going on well in advance of him leaving Car Group. Is sort of my point.
Yeah, so that's not an issue. I mean, he can he clearly had. The question is, why was he leaving Cars Group? Maybe after 7 or 8 years. Man, I think after doing it for 7 or 8 years, you want to change. Everyone mentally wants to change, to do something different challenges. Because a lot of the time when you run in these businesses, after the first sort of 1 or 2 years, it becomes the same old type issues: price increasing, customers, the continued evolution of technology within the business. And you if you're a creative individual, an entrepreneurial individual, you have to be you have to think, you want new challenges, push yourself. And you know, REA is materially larger than Cars Group. I don't know the size of Cars Group, but my guess is it's probably a 10 to
had about $1 billion revenue in its full year. So
okay,
it's not a small business.
No, in terms of market cap, do we know?
I don't know. That's a good point. We'll find. You do some research, and then we'll maybe start segueing us onto something else.
Our next piece of news is, well, it's kind of non-news. Harvey, why don't you fill us in on the second piece of news that you've got on the roundup sheet here?
Yeah, so Michael Layani went to an event and he spoke on stage. He's a CEO of Property Finder, and he's basically said Property Finder is not in a rush to go public. He said it's a headache. He said it's not for everyone. And he said you basically have to exhaust all your private investment options before you even think about going public. It's a last resort. And it reminds me of a conversation we had a long time, Simon, back when this was a brand new podcast. We spoke about going public. I thought it would be nice to bring back that conversation that doesn't matter how big your business is. It can even be a unicorn, which is what Property Finder is, operating out of Dubai. But even then, going public isn't all it's cracked up to be.
Yeah. So when we interviewed Michael Layani back in March last year, his words were one day. We asked him and he said one day. The reason that this is, I guess semi-interesting is that we haven't really had a big IPO in real estate portals for quite some time. I think we had a flurry of them in kind of 2021. We had Property Guru, we had Hemnet, Baltic Classifieds Group. There's another one that's kind of escaping me now. And since then, there's been talk of Jabizzle Group, Property Finder. There was one other as well that's escaped me that we've had talk of maybe going public. We've not had any since then. Simon, you've taken a lot of companies public. You know better than most the trials, tribulations, headaches of going public. Do you think we will see a real estate portal going public in the next 12 months? Because I quite like when they go public because I get to see all the numbers, basically.
Yeah, the answer is probably not, because first of all, if you're going to go public, you've got to go public for a reason. Okay? Usually it's liquidity. A lot of small shareholders in the business. You like where it's going. You want to create some sort of liquidity event and have trading in the shares and allow the market to determine the value over time. Now, the problem with being listed is that everything is transparent. You're forever at the whim of market conditions. So you have two sort of issues that you have to face. One, I've got a crazy dog here. Wait. Sorry. How funny is that? So wait. I'm gonna have to hose the dog down. Oi, stop, Mocha. Stop. Hey. Okay. Sorry about that.
Our first official derailment on the podcast.
I know. It's a very cute little derailment. There we go. Here's our latest podcast attendee. Hey, everyone meet Mocha. Hi.
Mocha.
Okay. Go chase a lizard. Okay. Now so when you do this, everything is transparent. You have your shareholders, for whatever reason. There are sort of three things. One is there's the market as a whole. So something happens in the United States and suddenly the global markets are down 2-3%. It's like that affects you, and because you're a micro stock, a small stock compared to most of the large players out there, you'll get hit more. Two, you have some large shareholders who, for whatever reason, don't like the story. You're not achieving the growth rates they want, so they then start selling you. Now, then once someone sells, they all sort of pile in after each other, and then you have this downward pressure on your stock. Three, you say, I'm going to do 50 million in revenues, 100 million in revenues, and you miss by a bit. They go bang, slap, and then your share price goes down because you didn't deliver on the story. Now, of course, if you say you're going to do 100 million and you do 120, they then go, wait a second, you didn't forecast very well, did you? And you were sandbagging, right? Keeping the numbers that low. So therefore, so next time you say a number, we're going to add a percentage on top of it. So now you create this false economy around what it's like. People play the guessing game around your stock. And finally, sometimes your shareholders have their own issues. Funds have redemption calls, so they've got to pay out money to their LPs. And when they do that, they start selling your stock to get cash so they can then pay cash out. I've had that happen to companies. So a lot of these things are out of your control. And when they're out of your control, your shares get smashed in the process. And that's not good. So you want to be a very big, large, profitable company. Now, the question is, I think if you look at something like Property Finder, okay, they've done very well just using people like General Atlantic and other funds sort of investing in their business. And REA used to own 51% and sold it back to Michael for a song for like 100,000 back in the day. I mean, I think that's probably one probably was not a good decision in hindsight. And what that shows is that if you've got a good company and you've got good shareholders who support you over the long time, and maybe you've got small shareholders who want to get out because they've been shareholders for 5, 6, 7, 8, 10 years, then you can use secondaries to create liquidity for them. And if the company is profitable and creating dividends, then everyone's happy. It can self-fund growth. When you go onto the public markets, you're opening a whole world of pain. I think the other thing that we've got to be also mindful of is that there's a lot more competition now in the Middle East. Not the Middle East, in Dubai and the markets that Michael operates in, MENA, Middle East, North Africa. You've got EMPG, who's operating there, and they're so they too would probably be having, thinking about IPOing or creating a big liquidity event, because they too, as investors in that business, have been shareholders for a good probably 20 years. Starting with Zameen in Pakistan and then moving out. So I think there's also the other issue is there's probably a lot more competition now than there was 4 or 5 years ago in that market, which also makes it harder to deliver on the growth prospects. Because the one last thing is, when you do IPO a company, you have to do forecasts, and that's what you're going to be held to. So very hard to do that in today's world, which is there's a whole lot of volatility. And if you're based in the Middle East, and clearly there's a lot of volatility at this point in time. So I think there are many issues that would come together that would say to me, being private, having far more control of your share register, not having to worry about what the public markets think, not having to select the right public market to go in. Do you go into do you list in London? Do you list on the NASDAQ? Where do you list, right? Because you can list anywhere nowadays. So I think there's a lot of things that come together that says, no, I'm going to control what I can control, and then worry on operationally, which is where I've got to continue to excel. And then my last thought is, often the reason for IPOing is to allow founders a way to progressively get out of their business, which is what you do. You can sell down. I can sell down 3, 5, 10% of my stock. But you can do that privately as well. Okay. Now, one of the beauties of being listed is that the listed stock is actually currency. Okay, so if I own 5% of a listed company, that listed company is worth $1 billion. So that means I've got $50 million worth of value. I can actually borrow money against that without having to sell my shares. I can just take a margin lend against my shares. And if I'm confident enough that they're not going to move too much, and then I have a currency I can play with. So there's a lot of value to the founder of being listed, of course, in this game.
Okay, so speaking a little bit about the headaches of being a listed company brings us on quite nicely. A nice segue to our third story today. Harvey, why don't you fill us in what's been happening in China?
Yeah, so Simon was talking about sandbagging your numbers, protecting yourself, giving negative forecasts, negative reflections of perhaps future performance. What if you're inflating your numbers? What if you're telling lies to the market? So that's what has been alleged against KE Holdings in China. And it has now settled a claim with a company. Sorry, let's rephrase this. Muddy Waters Research has done an investigation into KE Holdings and found that it overstated gross transactions, revenues, agent numbers, active stores, quite a few metrics that go into share prices and performance when it does its public financial statements. KE Holdings saw its share price drop 20% because of the findings that found that it had been inflating its numbers. So now investors have been shared options for reclaiming maybe some lost money based on their share prices, because they basically, it looks like they fudged the numbers, Ed.
Okay, thanks. This isn't related to something that happened recently, right? This is related to investor presentations from a few years ago, right?
This is going back to 2021, and the settlement was made in April 2025. So this is sort of going back a few months, but now investors have a chance to make a claim against potentially loss of earnings from holding on to devalued stock based on the fudging of the numbers. Bit complicated, but that's the basics.
Yeah, this is not the first time this has occurred in the online real estate world.
Okay,
and
tell us, Simon.
Okay, Ed, before you were born, okay, and probably you too, Harvey. No, I didn't. A long time ago, back in 1990, about 1999, 2000, maybe 2001, Home Store, as it was known in those days, the CEO, whose name I can't remember, something Wolf,
Yeah. We spoke
Um,
the other day and we put a
oh,
link.
did we? Oh, yes, we did. Yes.
Link in the show notes too, because it's a very good story.
Yes. So this is a long time ago. It's about 20, 25 years ago now. The CEO of what is now Realtor.com, back in those days, they did what's called a round robin. So they spent advertising money on maybe Yahoo, or I can't remember, it was one of these things, and then they then spent advertising on another company, who then spent advertising back on Home Store, as was known in those days, and they then used that to artificially inflate. So for $1 of marketing out, I got $1 of revenue directly back, right? And it sort of did this sort of round robin. If I remember correctly, and it was a long time ago since I've read the article, read the story, but I remember it actually occurring at the time. And that led to an artificial inflation, and the CEO went to jail, okay, for artificially inflating the numbers. Now, clearly, the worst thing you can do, one thing is to have numbers and put them out into the market and get them wrong. Wrong because they're forecasts and you didn't hit your forecast, okay? People know that this is not an exact science. It's as much as an art as it is a science, growing these businesses. And if you're not 100% sure, you sort of have your best guess. But when you actually know numbers and you potentially inflate them because you want to look better, then that's an absolute no. You cannot do that, because investors are playing with their money, investing into your business, okay? And if they're buying something that's worth, they think it's worth $5, it's really worth $3, then clearly they've got an absolute claim against the company for misleading. And it's very, very important, and you learn this when you're a director of a business, that you must make sure that your numbers are all verified. That's why you have auditors. That's why you have internal controls. You'll have an audit and risk committee on the board. The whole objective is to make sure that the numbers you put out are accurate, or the most accurate they can be.
And these weren't like, 1%, 2%. Like KE Holdings got like a 77% increase in revenue. Like that's a huge inflation of their numbers, which
I'm super surprised. I mean, I'm not surprised that clearly there's always a company, because they're a US listed company. Okay, then you've got and the US is absolutely rife with litigation, and there will be some company out there that's going, right, I think these numbers aren't real. Let's dig in. Now the problem is in the US, and I've got a friend who has got some stuff in the medical industry, and he's still in litigation with another company for theft of trade secrets, and he's about 5 years into the process, and it's still going through the court system. These things take a long time to go through. So I'm not surprised that these, what do you call them, Muddy Waters? I think Muddy Waters.
Muddy Waters Research.
Muddy Waters Research, also a band, I thought. Anyway, so it takes time. They would have had to do the research. They had to get proof of the numbers. They may have had to even gone and count them. I don't know how they would have done it, but they would have proven that these numbers aren't out by 1%, but they're out by a lot. They would have to then take that to a court. Court would then have to go through a whole discovery process. We've got to share documents about really what's happened. And then eventually, clearly, KE Holdings have gone, let's settle this so we can get on with our business, because it's clearly having a damaging impact on our share price. And it did, if it dropped by 20-odd%, as you said. That's not good.
Yeah, I'm just looking at these numbers here. So as I'm sure a lot of listeners know, I collect these numbers every quarter on a spreadsheet. KE Holdings is one of the companies that I have collected numbers for since early 2020. I'm looking at them here, and yet they do drop off a cliff quite significantly in 2021 Q2. Now, I'm sure it coincides quite well with a drop in the Chinese housing market, but just doing the little kind of spark line that you can do on Google Sheets here, it's quite a very pronounced drop off. I've always been curious about how they count the number of agents and number of stores, because they give it to the exact number. So number of agents Q2 2021, 548,600 exactly. It seems, like that's a very exact number that
It's
you have to collect.
probably user IDs and passwords that have been set
that?
up in the agency
Absolutely.
database.
I
Right?
do remember thinking that's very good disclosure that they've got it down to, because most companies, when it comes to disclosing these kind of operational metrics, sometimes they'll vaguely put it in a paragraph somewhere, and then the next quarter they won't tell you or something. But KE Holdings, I was surprised because they always seemed like they were actively trying to disclose as much as they could. So it surprised me to read it.
It was interesting because one of the things that Muddy Waters research brought up was number of stores and number of agents, and saying that quite a lot of them are obviously going to be inactive. So active agents is much different to overall agents. And that, again, is quite a nice bit of PR, because you can say we've got 50,000 agents. If only a dozen of them are actually doing business, then obviously it's going to have a massive impact. But if you have a nice headline figure that maybe is potentially a little bit of a white lie, it's going to sound good to the shareholders, isn't it?
Yeah, I mean, what's interesting is when you look at other industries, and my son has a small but growing crypto business. He's always talking about daily active users, because that's the measure that he cares about, is how many people are using this product today, okay, or
And
daily,
tomorrow.
weekly users, weekly active users and monthly active users. They're the three metrics. And then clearly you can look from your daily active users, extrapolate out for a month, look at your monthly active users, and you get an idea of repeat usage during that time. But the fact that an account exists, and he's got lots of accounts set up, but people don't use it, that's useless, right? If you're running a company and all you got is a user ID and password, best you've got is some email addresses for marketing. In reality, unless they're paying customers or unless they are actually using your product, it's not relevant. So that's why I think this is interesting, going back to KE Holdings, is having a look at, well, what are they really doing? Okay, and I think that the message here is for investors everywhere, you've got to understand the right KPIs for whatever business is that you're looking at. What are the true drivers of revenue? So, for example, if I'm running a property portal, yes, I might have 5 million people, 10 million people visit the site each month. How many of them are actually looking to buy a house? And how many of them are generating leads in that process? The fact that Ed may go and look at a website because he's interested, thinking, I've got to renovate a bathroom, I want some ideas, I've got a few hours, I've got a time, I'm just going to flick through, I'm on a train or something, I'll just flick through some pictures. Or I'm interested in, what's the value of the house down the road, but I'm never going to sell. Just looking at my own personal property. They're not really valuable. It's just numbers, right? They're just numbers on your website. What's interesting is how many people are looking to buy and looking to rent, and how many of them are generating email leads that are not saying, do you have any more pictures? Because I'm renovating my bathroom. But do you actually have more pictures? Because I need to buy something and I'm sort of liking what I'm seeing. And can I set up a meeting, please, to look at the property? And a lot of the time we put all those numbers into one big. We've got our visitation is 10 million people, or in some websites, I think Trade Me might be a good example. There's more visitors to Trade Me than there are New Zealanders. Well, wait a second. How does that work? Okay, so I think they're the things that that as an industry we've never really tackled. Okay, because I think when we get below the covers, the numbers aren't great. And if we don't have really great numbers, then we can't then be charging the prices that we are at the other end. And if we can't charge the price at the other end, then our revenues, start to look a bit wobbly. So what we do is we always go for the biggest number. Hey, I remember I'm being guilty of this, right? From the days at early days at REA, we would take any metric that was a big metric, big and growing. Talk about it. I think we had some silly saying, if it's big and growing, start crowing, right? Just talking about it, screaming about it, okay? And
congratulations on the rhyming.
And if it's small and shrinking, it's stinking. So
for goodness sake.
We found the clip for this week's episode there.
Okay, there you go. No, we are going back 25, 20. 20 plus years. No, 20 odd years. I don't remember exactly time now. But the point is, everyone wants to have big numbers. If you look at a lot of the headline numbers they put out, 25 million unique visitors last month, up 30% from the year before. Okay, X number of agents up from, well, the number of agents never really goes down because they're all on subscription. Of course, they're going to grow. Okay. Now, the question is, how many of those are active subscriptions? How many of those are paying subscriptions? Someone's got a subscription. It's like I know I've got subscriptions to many things which I've signed up for. I don't pay anything. I'm probably accounted in those guys' numbers, whoever those websites are. We all play with AI, right? We all sign up for something. But doesn't make me an active user. Doesn't make me actually valuable to that company. It just means I've got an.
All right. It seems like a nice interlude here to have you, Simon, tell the audience, give them 3 reasons why they should be buying their tickets for Property Portal Watch now,
Sure.
as opposed to last minute.
Please don't buy them. Don't buy them last minute. Well, first of all, we're capping the number of attendees about 400 this year. Why? Because that makes it a great experience for everyone. So we don't sort of cram people from the rafters in the room. We're already well over halfway to that with 2 months to go. And we always know that the last few weeks, it goes sort of crazy with people coming back from holidays and signing up. So 3 great reasons to sign up. A is that the tickets are the cheapest they're ever going to be right today, and we're going to put the prices up in the next week. So sign up today, save yourself a bit of money. 2, we've got some fantastic speakers coming in from around the world. The CEO of Vend, for example, we've got Mike Del Pret coming out of the US, and so on. We've got a lot of very, very, very good speakers. 3, we've got amazing companies coming this year. The list of companies attending is already looking better than the list was last year. So if you're going to come and you want to talk to people in the industry, so whether you're a supplier to the industry, whether you're a participant in the industry, whether you're new to the industry and you want to understand what is happening in the online real estate world, or the prop tech world, if it's really much more than online real estate, then you should be there in October from the, I'm going to get these wrong, 15th to the 17th, I think it is. I got it right this time. 15th to the 17th of October in Madrid. And we run social events every night. Great way to network with everyone from, the CEOs of companies like CoStar to small startups who are just wanting investment, wanting to understand how to really make the most of their journey in this industry. And lastly, but not least, the key sort of themes are a lot around AI, a lot about how that is really fundamentally changing the industry and has the potential to make it seismic change. So if you want to hear from people who are experimenting, learning, making mistakes, but are happy to share all of this, then you have to be there. October 15 to 17 in Madrid. Go to ppweurope25.com. That's ppweurope25.com.
Yeah. So on the topic of speakers, I probably say this every year, but it's a really impressive list of speakers this year. And I think I actually have 2 phone calls this week with 2 more European, genuine, market-leading real estate portals who want to speak at the conference. And we are this close to signing a very, 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 very big name as well on top of that. So hopefully we'll have some news to share with people very soon to make the lineup even better. Okay, we'll move on to our love story this week. Harvey, I'll let you just introduce the story and tell us about it.
Yeah, sure. So speaking of CoStar, Andy Florence has been at the conference for the last 2 years. Homes.com, CoStar's residential portal, has added a new homes section to its portal. Homes.com is part of a company-wide strategic review at the moment on how we're going to monetize. So I think Homes.com must think that there's some revenue to be made here, but we've already got 700,000 new homes listings nationwide on the new homes segment. We've got move-in ready properties, custom builds, available lots, communities and early development. They're going to have video tours, Matterport walkthroughs, photography. The new construction home segment, 700,000 listings across the United States. Yeah, it looks to me like it's going to be a nice little addition to Homes.com, which, as you've written about, Ed, needs to start making some money.
Yeah, thank you, Harvey. I thought this one was reasonably interesting, not just because Homes.com launches new property segment. It sounds, it's a bit of a dry headline. What's interesting to me here is when you, as I have done, look around the whole world, all the real estate portals that are out there, it's actually a very big percentage of them that are specialist new home real estate portals. But in the US, I don't think they have any. I mean, I could get my spreadsheet up and have a look, but it would take a couple of minutes. I'm going to go out on a limb and say in the US, there are either none or maybe one or two very small dedicated new home real estate portals. I tend to think that they do quite well. I know for a fact that Zoopla in the UK has done very well promoting and integrating new homes into what they've been doing recently. It just seems like a really profitable segment, and it just seems like it would make sense to put a lot of emphasis on that segment if you are a real estate portal. If not, actually spin it out into something different. Simon, what's your take?
You're on mute.
So not anymore.
Not anymore.
My view is, first of all, you're crazy if you don't have a new home segment, right? And you don't cater for the new home segment. It's just another source of real estate listings. If I want to move to, I'm in a suburb at the moment, or a town here in Florida called Golden Beach. If I want to move to Golden Beach, do I really care if I'm buying an established home or a new build? The answer is no. I want to live in Golden Beach. That would be the first thing. So then what happens is you say, right, why is it then that we have to treat them separately? From a buyer's perspective, is it different? Probably not. The only difference may be that you've got to wait 12 months or 18 months, okay, for the project to be finished. So from a buyer perspective, it just should be shown to them as part of the solution set, available in January 2027. Okay, I'm happy to wait. And by the way, I can pay over time and I can manage my finances and so on. From an advertiser perspective, the new homes developer is far easier to deal with. Okay, you're not dealing with a real estate agent in the middle. You're dealing with a developer who wants leads. I just want leads. I got to close out this deal. I got to close 30% of the sales so I can get my next level of financing and so on. They have a process that they go through. So if you can help them generate that outcome as a real estate marketplace, then you're doing a great job. Often the developers will share commission with you. That's a great way to and you're not treading on anyone's toes in that process. You're not pissing off the real estate industry because the developers sort of run in parallel to it. So there are a lot of benefits from doing it and handling it. Often, though, it's done as a separate tab because, we're a real estate agent. We don't want to have new developments next to us because, they see it as diluting the number of, or giving more options for a buyer in a market. We want them just to buy from me because I'm getting a commission versus they could buy a new development. But all those things are sort of, at the end of the day, you have to, if you're serving the needs of the consumer, the buyer, then you're doing a great job in that process. Now, the new homes development clearly needs to have, you got to think about it differently. As a product, you're going to put up an apartment building with 500 apartments in it. So you've got to think about the building and the amenities, and then you've got to think about how many floor plans there are, not how many apartments. If you flood the site with 500 apartments, okay, it sort of contaminates that suburb search with 500 of the same thing. Right? Normally there's like 500 apartments and maybe 10 different floor plans. So there's 50 of each. Put up the 10 floor plans and allow people to inquire around those 10 floor plans. Okay? That's sort of the way. You've got to think about the product in a slightly different way. But it's still the same underlying objective, which is generate leads for the advertiser. Oh, the last thing is developers have a budget. They're used to spending a lot of money. It's much easier to get money out of them if you're delivering results. They're very result focused. It's less about, it's just a much easier sell in the whole process. So yeah, I think putting a new development segment in is like wake up in the morning and seeing the sunrise. It's like, yeah, of course, right? You should absolutely have it. And then it should be smart about how you integrate it.
Yeah, absolutely. Okay, gents, I think we'll leave it there. Just quickly on the subject of new developments, we are hoping to bring you an episode with somebody who runs a real estate portal that just does new developments. So we will dive into that topic hopefully very soon. Okay, Harvey, Simon, thank you very much for your time, and we'll see you on the next episode.
Okay.
Bye-bye.
Thanks, guys. Have a great day.